Here are the latest housing market update for the month of May based on the latest newsletter of Victoria McCaskill. Despite persistently high interest rates, housing prices continue to increase month over month. The median sold price for all property types in May was $595,000, up 2.59% from a month ago. If this trend continues, prices will be up year over year by September or October. The market peaked in April of 2022, and due to high interest rates declined steadily for the remainder of the year. Since January, though, prices have steadily increased month over month. In April, the median sold price was down 6% year over year when compared to the peak of the market in April of 2022. In May, the gap narrowed to down 3.25%. In May of last year, values began declining, whereas this year values continue to increase. Historically, prices decline in the summer months due to an increase in inventory. Other than during 2020, which was impacted by the spring lockdown and the subsequent remote work boom, between 2018 and 2022 prices shifted down in the summer months. This is largely due to an increase in inventory as families move over the summer once school is out. This increase in inventory satiates demand and gives buyers more negotiating power, which then leads to a slight decrease in prices. There are two factors that may buck the summer trend this year. The first is that we may not see as big a boost in inventory this summer. May ended with 5,228 active units available at month's end. The average inventory for the month of May for the years 1985 to 2022 is 14,895. One of the largest contributing factors to low inventory levels is high interest rates. Homeowners with a 3% interest rate are not in a rush to sell their existing home and then buy a replacement home with a 6.5% interest rate. For many homeowners, this move is not financially feasible, and this is keeping inventory levels low. There are some exceptions to this trend. Inventory levels are higher in the outer suburbs where new communities are being built. Builders are adding supply to the market in these locations, which in turn keeps inventory levels higher. If all other economic conditions remain the same, when interest rates come down, both demand and prices could once again explode. It's very difficult to time the market with low inventory levels given how interest rate sensitive the market is. A slight drop in rates boosts demand. On the other hand, if interest rates decrease but we are experiencing a deep recession, demand may wane due to unemployment. Other considerations are the resumption of student loan payments. With less disposable income, consumers will spend less, which could reduce inflation and subsequently interest rates. One negative outcome could be fewer buyers will be able to take out a loan since they have the additional costs of student loan repayments. The second factor that may keep prices elevated this summer is the type of inventory available. Given that the typical homeowner cannot give up their 3% loan for a 6.5% loan, who is currently selling their homes? With the move-up buyer sidelined, a larger percentage of the available inventory are homes that may be distressed, as the seller has to sell instead of the seller wanting to sell. These sellers could be estate sales, divorces, relocations, or sellers facing financial hardships. But with high interest rates, buyers are very picky and expectations are high. If they are going to be buying a home and paying 6.5%, the home had better be near perfect. These high expectations create a divided market. Homes that are in great shape, in great locations, and have great floor plans are in high demand. So much so that we are still seeing multiple offers on these homes. The median days on the market for all homes are a mere 6 days. If a home is priced correctly and meets buyer expectations, it will sell in just a few days for over the list price. This trend continues to drive prices up for enough inventory that overall the median home price continues to increase. The flip side of this is that homes that don't meet buyer expectations will sell for below their list price and sell lower than they did a year ago. This was not the case a year ago, when buyers would buy anything regardless of condition. It used to be that buyers had to act quickly and settle for any property available to lock in a low rate before rates increased. Buyers are not feeling that pressure. Additionally, with renovation costs having skyrocketed, buyers expect to see a discount for homes that need work. We also aren't seeing buyers waive inspections and appraisals as they did a year ago. So even though prices are increasing month over month, they are increasing at a more sustainable rate, and sellers are still needing to provide concessions for inspection items or rate buy-downs. If you are looking for short-term or long-term rentals or are interested to buy a property in Denver, Colorado, contact Homes Real Estate Group. We will get you in contact with the best real estate agent for your particular needs.